In the vast and intricate ecosystem of financial markets, traders and investors are constantly seeking patterns and indicators to navigate the unpredictable tides of price movements. Just as a seasoned naturalist observes the behavior of animals in the wild to understand their motivations, market participants turn to various analytical tools to decipher the language of the markets. Among these tools, Elliott wave theory stands out as a compelling approach that delves into the psychological underpinnings of market trends. Developed by Ralph Nelson Elliott in the 1930s, Elliott wave theory postulates that market prices move in repetitive patterns driven by investor psychology, reflecting the ebb and flow of optimism and pessimism that govern collective human behavior. Like the rhythmic crashing of waves on a seashore, Elliott observed that market cycles unfold in predictable patterns, reflecting the underlying sentiment that propels them. Elliott wave theory rests on the fundamental premise that market sentiment, the collective psychology of all market participants, drives price movements. Just as a crowd's mood can shift from euphoria to panic in an instant, market sentiment oscillates between periods of optimism, driving prices upward, and pessimism pulling them down. These fluctuations in sentiment create the characteristic wave patterns that Elliott identified. Imagine a group of animals moving together across a vast plain. They move as one, driven by instinct and a shared purpose. Similarly, market participants, influenced by a constant stream of information and their own interpretations, collectively drive price movements, creating trends and reversals that can be analyzed through the lens of Elliott wave theory. Elliott wave theory suggests that these waves are not random but follow a specific structure, allowing traders to anticipate potential future price movements. By understanding the underlying psychology driving each wave, traders can make more informed decisions and navigate the complexities of the market with greater confidence. The cornerstone of Elliott wave theory is the identification of a complete cycle comprising 8 waves, 5 impulse waves that move in the direction of the main trend, and 3 corrective waves that move against it. This pattern, Elliott observed, repeats itself across different time frames, from minutes to decades, a principle known as fractality. Just as a single drop of water reflects the vastness of the ocean, each Elliott wave cycle, regardless of its size, embodies the same underlying principles of market psychology. This fractal nature allows traders to apply the theory to various markets and time frames, from short-term day trading to long-term investing. These 8 waves, like the notes of a musical scale, combine to create the symphony of market movements. Understanding the characteristics of each wave, their typical duration, and the sentiment they represent is crucial for successfully applying Elliott wave theory. Wave 1 marks the beginning of a new trend. It emerges from a period of consolidation where market participants are uncertain about the future direction. As positive news and improving fundamentals start to emerge, a small group of early adopters, sensing a shift in sentiment, begin to buy, pushing prices higher. Imagine a lone bird taking flight from a tree, tentatively testing the air currents. Similarly, Wave 1 often represents a tentative move, characterized by low volume and limited participation. Not everyone is convinced yet, and many remain on the sidelines, observing whether this nascent trend will gain momentum. However, this initial push, though seemingly insignificant, sets the stage for the larger waves to follow. It's the first ripple in a still pond, hinting at the possibility of a larger disturbance to come. Section 5, Wave 2, a moment of doubt. As Wave 1 progresses, some early buyers decide to take profits, while others, still unconvinced about the sustainability of the move, start to sell. This profit-taking and renewed skepticism lead to a pullback, forming Wave 2, a corrective wave that moves against the primary trend. Just as the lone bird from before might briefly pause its ascent, adjusting to the wind before continuing its journey, Wave 2 represents a healthy correction, allowing the market to consolidate its gains and test the underlying strength of the nascent trend. During Wave 2, it's common to see a decline in volume compared to Wave 1. This lower volume suggests that the pullback is primarily driven by profit-taking rather than a complete reversal in sentiment. The market is merely catching its breath before the next leg up. Section 6, Wave 3, the surge of confidence. Wave 3 is typically the most powerful and dramatic wave in the entire cycle. At this stage, the skepticism that characterized Wave 2 dissipates, replaced by a growing chorus of bullish voices. The initial trend, once tentative, now appears confirmed, attracting a broader range of participants. The lone bird, now joined by a growing flock, soars confidently through the sky. Similarly, Wave 3 is characterized by strong buying pressure, high volume, and significant price advances. It's during this wave that the trend becomes undeniable, attracting media attention and drawing in more participants, further fueling the upward momentum. Wave 3 often extends beyond the length of Wave 1, reflecting the increased confidence and participation in the market. It's the wave that most traders and investors aim to ride, capitalizing on the strong momentum and the potential for substantial profits. Section 7, Wave 4, Consolidation and Anticipation. After the exuberance of Wave 3, the market typically enters a period of consolidation, forming Wave 4. This wave represents a pause in the upward trend as some investors take profits, while others, hesitant to buy at these elevated levels, wait for a pullback before joining the rally. The flock of birds, having ascended to a significant height, might circle above the ground, conserving energy before continuing their journey. Similarly, Wave 4 is characterized by sideways price action, lower volume, and a general sense of uncertainty. The market is taking a breather, digesting the gains made during Wave 3. While Wave 4 is corrective, it rarely retraces the entirety of Wave 3. The underlying bullish sentiment, though somewhat diminished, remains intact, setting the stage for the final push of the impulse wave sequence. Section 8, Wave 5, the final push. Wave 5 marks the final push in the direction of the dominant trend. By this stage, the market is often driven by a sense of euphoria and complacency. Even though the fundamentals might not be as strong as during Wave 3, the fear of missing out, or FOMO, compels many investors to join the rally, pushing prices higher. The flock of birds, after a brief respite, embarks on a final, powerful surge, reaching its destination. Similarly, Wave 5, though often shorter in duration and less dynamic than Wave 3, still represents a significant move. It's the final act of the bullish play before the curtain falls. However, Wave 5 is often marked by divergences between price action and volume. While prices might be making new highs, volume might be lower compared to Wave 3, indicating a waning in momentum and a potential reversal in the cards. Section 9. Corrective waves, retracing the steps. Once the 5 impulse waves are complete, the market enters a corrective phase, consisting of 3 waves labelled A, B and C that move against the primary trend. These corrective waves are typically more complex and less clearly defined than impulse waves, often characterized by overlapping price action and a higher degree of uncertainty. Imagine the flock of birds, having reached their destination, now dispersing, each bird seeking its own path. Similarly, during corrective waves, market participants' opinions become more divided, leading to more erratic price movements. Corrective waves are essential for the long-term health of the market. They provide an opportunity for prices to consolidate, allowing for a healthier and more sustainable trend to develop. Understanding the dynamics of corrective waves is crucial for identifying potential trading opportunities and managing risk. Section 10. Conclusion. Riding the waves of the market. Elliott wave theory, like a seasoned guide in unfamiliar terrain, offers traders a framework for understanding and navigating the complexities of financial markets. By recognizing the repeating patterns of investor psychology reflected in price movements, traders can anticipate potential turning points and make more informed trading decisions. However, just as a guide can only provide direction and not guarantee a safe passage, Elliott wave theory is not a foolproof system. Its subjective nature, reliance on interpretation, and the difficulty in identifying wave counts in real time make it a challenging tool to master. The true power of Elliott wave theory lies in its ability to provide context and clarity amidst the noise of the market. By combining it with other analytical tools, such as technical indicators and fundamental analysis, traders can enhance their decision-making process and navigate the ebb and flow of the market with greater confidence.